Welcome to Taking Stock for the week ending the 4th of March 2022. Joining me today is our Managing Director and Chief Investment Officer, Tim Lincoln, to stream to you all things share markets. Thanks for joining me today, Tim.
Yeah, great to be here with you, Kien, as always, and great to be here for our members to help guide them through this current share market environment. But our hearts certainly do go out to those members and families who might be suffering some challenging times on the back of the floods on the east coast of Australia.
Yeah, we hope everyone is safe and well there. So, with the recent market volatility, Tim, what are you thinking at the moment?
Well, it's crazy, isn't it, Kien? It continues to be crazy. It's really unpredictable. And there's plenty at the moment to create doubt and nervousness, especially in the minds of newer investors to the market. We've got the Russia-Ukraine war. Who knows what that could escalate to? We've got rising inflation that could influence increasing interest rates in the not too distant future. And we've, of course, got the global fallout and economic fallout from the impacts of COVID. So there's a lot there to consider. But we must endure. At the end of the day, we've got to focus on the long term and focus on the quality of the companies that are contained within our portfolios. And especially now, there's so much short-termism occurring, so much speculative product, i.e. cryptocurrency and the like, being introduced to the market. We've got to avoid being attracted to over-speculation and, of course, block out all of that noise and focus on the bottom-up perspective, and again, back to the quality of our portfolios. And at the end of the day, yeah, it's really volatile, isn't it? We wake up every morning to see what's happening in the US, expect the same thing to occur in Australia, but then, there's really no connection between the two at the moment. Everything is incredibly volatile. But I believe over the long term, Kien, that the share market will continue, or it has to continue to be an essential global asset class. And just because of that sheer weight of money and demand for that essential asset class will continue to drive the share market up over the medium to long term. So it's certainly not doomsday. And for those that have been in the market for a long time, we've seen it all before. So we're quite conditioned and really should be looking at the volatility as opportunity. And if the market wants to foolishly oversell high quality businesses, then I'm there to gobble them up as an opportunist. And our Australian and US funds are there to do the same. And we believe, again, over that medium to long term, that the opportunities that have been presented in some of these companies will benefit enormously in the not too distant future.
Right, Tim. So what strategies are you then employing, especially around the US funds, and what do you suggest our members do?
Yeah, as I touched on a moment ago, Kien, I'm an opportunist. I manage the growth funds, the Lincoln Australian Growth Fund and the US Growth Funds, from an equal weight perspective most of the time. So we love the companies that are contained in there, all star stocks, and we love them. But when they get oversold, hey, I'm in there to gobble up those oversold opportunities. And right now in Australia, we're quite excited about the share price pressure that companies like Altium have come under, even Cochlear, ARB, beautiful businesses that have been quite oversold. They've got their active risks as that you and the analysts clearly point out, but again, they have been considerably oversold, and ResMed, Macquarie Bank even. So we're really excited about these growth businesses that are being oversold, and we're taking above equal weight active positions in those types of businesses. In the US, there's huge companies that are highly liquid, and they've been oversold even more. And they're really exciting stories relative to future tech and the like. Companies like Enphase, Etsy, probably foreign names to a lot of Australian investors, haven't heard of them, but they meet all of our financial metrics that Stock Doctor covers. Even Adobe, Intuit, and many more. So Matt Schwartz and myself are really quite active in loading up on many of these companies in the US growth funds, but more on these strategies and how we can actually manage those in question of the week, Kien, later on in the video. But those who are trend sensitive in this environment, there's obviously SD Max and SD30 TSR there to help those who would prefer to be preserving capital in this environment, as opposed to me being the opportunist. So there's all the strategies there to employ relative to the current craziness that exists in the market.
So on the back of those who are sensitive to volatility, Tim, how should the new investors navigate the current environment?
Yeah, new investors or even new members to Stock Dr. Kien, and let's assume that they are new investors.
Mm.
It's been a baptism of fire, hasn't it? But what a wonderful environment to be learning in and also becoming conditioned for the future. So there's three pretty important disciplines a new share investor or new member should adopt in this environment. And Kien, I know you're big on this one, that all investors' portfolios ideally should be constructed initially with 15 or more stocks to avoid over concentration risk. And ideally, too, really understand your objectives before you start out in the market. Are you a growth investor or are you an income seeking investor? And also determine your sensitivity to volatility. And that will help you determine whether you're actually there to embrace oversold opportunities or whether you should be in that more conservative mindset and more focused on preserving capital during volatility and therefore using one of our technical indicators to help preserve capital, SD Max or SD30 TSR. And I really encourage our new members, Kien, to contact yourself and the research team or a member of our wonderful support team to hold their hand if ever they need any assistance with the deployment of any of our strategies.
Yeah, we're always here to help, Tim. But the reporting season is now over, and in the final week of this reporting season, we saw slightly more earnings misses than beats. But this is not unusual since bad news it tends to be delayed. But despite this, around 74% of companies have met and beaten market expectations. And that's quite impressive given the inflationary cost pressures coming through and also those COVID restrictions. And to reinforce the strong corporate environment was the Australian GDP data released this week, which revealed a 3.4% uplift in the December quarter, and that bet market expectations for a 3% rise. Moving forward, you've got earnings growth for the market, and that's expected to be now at 14% for the year.
Yeah, good numbers there, Kien. Still representative of a really strong local economy, isn't it? And the better than expected reporting season has helped the market gain about 1.7% in February. January was a challenge, but it's interesting to see the market bounce so strongly in February. But the Stock Dr. Star growth stocks continue to be impacted by the rotation away from quality and growth towards larger caps and value, as can be seen on the chart on the screen at the moment. Global growth concerns and inflationary pressures, as we mentioned earlier, has led investors to shy away from growth stocks because of their future cash flows are perceived to be sensitive to higher interest rate charges, which creates the opportunity in oversold high quality growth stocks as they have the inherent financial strength to absorb higher interest rates. So these rotations are healthy because it resets the overbought nature of the market, especially at the frothy end where companies have had terrific runs, to be a more sustainable long-term uptrend. From history, we understand that these rotations are generally short-lived and usually represent that great investment opportunity that we spoke about earlier, which we'll showcase further at the end of the video. But all that said, it is great to know that even with all of the market influences and the noise presently at play, that over the last 12 months and since inception, our star growth stocks and star income stocks as a collective continue to deliver outstanding results to our members. By the way, our star income stocks, because of their more defensive nature and higher yields, are holding up very nicely in this current volatile environment.
Yes, Tim, quality tends to prevail in the end. But you did touch on an important point, and that's the relationship between, growth value stocks to interest rates. And many believe that growth investing has been spurred by this lower interest rate environment. Since 2008, interest rates have been largely in decline, but are now expected to rise on the back of this strong inflationary pressure, with both the RBA and Federal Reserve forecast to increase rates this year. As you can see from the blue line on screen, Australian interest rates are expected to rise from about 0.1% this month to around 1.4% in June 2024. Meanwhile, interest rates in the US are expected to rise at the same pace, but slightly at a higher margin as shown with the orange line.
And considering the collective of growth companies again, Kien, I touched on before how we believe that our star stocks have got the inherent financial strength, or our star growth stocks inherent financial strength to absorb the higher interest rates, so they won't be affected. But considering the collective, will these increasing interest rates really dampen the prospects for growth investors going forward?
To understand this, Tim, let's look at the chart on screen, which shows the correlation between the performance of value stocks and interest rate expectations, otherwise known as bond yields. Now, each prior decade is represented by a different color here, and the orange color is the most present time. As you can see, in recent years, there's been a positive correlation between value stocks and rising interest rates. However, over the past 5 decades, the average correlation has been zero and has oscillated between being positive and negative. So this implies that value does not automatically beat growth when interest rates are rising and vice versa. So what this really means is that although the market can react initially by selling down growth stocks when bond yields are rising, over time, growth stocks tend to recover irrespective of interest rate rises. And the reason for this is that other factors can play a role to help growth stocks perform well. And rising interest rates, it's often accompanied by improving economic growth, which also lifts future cash flows, Tim.
Also remember that much of the inflationary pressures have been a result of transitionary issues from the onset of COVID. These include excessive monetary and fiscal stimulus, supply chain constraints, and shifts in consumption habits from mobility restrictions and higher savings rates. Although the current high energy prices can compound inflationary pressures further, we believe this will eventually normalise and create less pressure on interest rates. And even if interest rates continue to rise, they remain very low relative to historical standards. In fact, interest rates in the US are expected to cap out at around 2.2% in 2024. Incredibly low. The RBA here in Australia is fully aware of the transitionary impact of inflation, and this week has kept the cash rate on hold at 0.1%, citing that it is prepared to be patient and does not intend to quickly raise interest rates in a response to the energy-led inflation spike.
Yeah, that's right, Tim. Investors shouldn't fear interest rate rises at all because the low interest rate environment should support equity markets for years to come. Especially over reporting, we've seen dividends being quite stable and rising as well, and so the income is still very attractive for a lot of investors. Let's now turn our attention to some star stock highlights over the week. Unlike many of the retailers throughout the reporting season, fast fashion jewelry retailer and star growth stock Lovisa, they exceeded market expectations despite facing supply chain pressures, including logistics delays and also shortages of store building contractors in those growth markets.
Yeah, what a result, Kien. In fact, return on equity improved to 67%. And net profit margins rose to 11% from 9%. So a wonderful growth story. This was driven by new store rollouts of 42 for the first half of the year, compared to consensus expectations of around 28. And favourable exchange rates worked in their favour as well. How are they able to do this, Kien? It's a great growth story, isn't it?
Yeah, that's right, Tim. The company's 81 stores in the US and also their presence in Europe and the UK, it helped offset the softer trading conditions in Australia. And the market was also buoyed by the fact that management, they suggested that they will open at least the same number of stores in the second half, with 18 new stores in the strong performing US market as well. Hence, the forecast earnings revisions in the last 3 months have been upgraded by about 17%.
Yeah, and we've seen a lot of retailers, haven't we, Kien, through this period, or a lot of businesses who rely on stock and inventory. They've had to increase that because of supply chain issues. Well, Lovisa's done the same, but it hasn't really had an impact on their earnings quality, has it? And that's super impressive. In fact, they increased their inventory by $90 million as it opens up a warehouse in Poland to manage supply chain constraints. So you can't really put all of the retailers in one basket and say, hey, they're having to increase inventory, therefore they're not an investment opportunity. Lovisa's really going against that grain, aren't they?
That's right, and they still reported very strong cash flows, Tim.
Yeah.
And moving forward, copper miner though, Sandfire Resources, they were sold down following their results, which were below market expectations. And just to remind our investors, the company underwent a major 1.9 US billion acquisition of Spain's Matsa copper mine, which also had zinc, lead, and silver in it. But this acquisition allowed it to extend its operations, given that its core DeGrussa mine is expected to expire this year.
Yeah, and the equity raise was dilutive to shareholders with annualized return on invested capital, Kien, which is part of our Golden Rule 2 criteria, falling to 50% from 66%. And this is expected to decline even further for the full year. It is why the market reacted so poorly to the result, and hence why you and your team had to have a good look at the stock.
Yeah, that's right, Tim. The market didn't like the fact also that Sandfire increased its production costs for the Spanish Matsa mine to around 94 US cents per pound compared to estimates of around 45 cents per pound in June last year. And the reason for the increase was that it was more difficult than expected to mine the lower copper grades. In addition, the Spanish electricity prices jumped due to Russia's invasion of Ukraine as well. And this led to significant earnings downgrades due to the dilutionary impact to shareholder returns and also those elevated active risks around the Matsa acquisition. Unfortunately, we've had to remove the stock from coverage. Also, at the end of the reporting season, the research team have continued to work quite hard, assessing the final set of numbers to look for more star stock opportunities over this week. There will also be a few star stock transitions between star growth stocks and borderline star growth stocks once our ranking model is finalized and all the results come through. But looking at our corporate calendar for the week ahead, we have Gold Road Resources. They are expected to release their full year 22 results. Meanwhile, Super Retail Group, Smart Group, Macmillan Shakespeare, Perpetual, Rio Tinto, South 32, they will be going ex-dividend next week.
And Kien, it's such an important time of year, isn't it? There's every reason that investors must be disciplined with their active approach to portfolio management. And the corporate calendar is a terrific tool together with the alerts to really ensure that you remain on top of your portfolios from that active management perspective. And there is a lot of churn in portfolios this time of year. There are hard decisions that must be made in regard to the removal and addition of stocks into ideally that 15 stock portfolio. It's just that time of year. That's the way it is with active share market portfolio management.
Yeah, that's right, Tim. And speaking about active management, for trend-sensitive investors who use the SD30 TSR, which is the 30% stop loss or gains from its highs or lows, we had Alkane Resources. They signaled an entry, while Altium and Lovisa triggered an exit. There were no changes seen on the SD Max, the Stock Doctor moving average crossover for the week. This week, we examined borderline star growth stock Lynas Rare Earths, a company that mines materials found in smartphones, cameras, electric vehicles, and rechargeable batteries. Despite facing logistical challenges, shipping delays, and a partial shutdown of its manufacturing plant in Malaysia due to COVID isolation requirements, the company was able to post an increase in annualized return on invested capital of 34% from 26%. And Lynas was able to do this because it proactively arranged its own chartered vessel to ship the concentrate from Fremantle to Malaysia. In addition, there was a rapid rise in the Chinese domestic prices of rare earths, which also helped drive significant uplift in their operating cash flows.
Now, Kien, you know our golden rules are very systematic. Now, we are numbers driven, and especially under Golden Rule 2, where we have our factors that we look at when making a decision as to whether we keep a stock in the star growth or borderline star growth or star income stock universe. And I noticed that, especially with Lynas, that they've actually got weak earnings quality. because of the suggested strong operating cash flow may not be there, or may be impacting that particular factor. So, how have you justified keeping it in as a borderline star growth stock? And should that be a concern to investors and ultimately yourselves?
Yeah, with these companies, Tim, we need to look at on a case-by-case basis, apply the qualitative factors to it. And during the period, Lynas made a 36 million payment to the Malaysian government in relation to the settlement of rehabilitation liabilities. So these payments are necessary as Lynas remains bound by local environmental protection guidelines. And we believe it forms part of the associated cost of doing business in Malaysia and therefore is not a significant active risk. But as a precautionary measure, we have transitioned the stock to borderline star growth stock status, Tim.
Okay, but before considering investing in this stock, members should be aware of the active risk Kien. And the active risks, some of them are quantitative, but some of them are also qualitative, hence why you've got that qualitative overlay and more a subjective opinion-based observation of some of these active risks Kien. And although the thematic of investing into green energy and electric vehicles is really, really attractive at the moment, rare earth prices can be subject to rapid corrections, can't they? And hence, that's one of the active risks you do look at.
Yeah, that's right, Tim. And on top of that, the other important active risk is the renewal of its operating license, which expires in March 2023. That's the operating license for Malaysia. The license has been subject to an anti-Lynas lawsuit, to which the High Court of Malaysia recently ruled in Lynas's favour, which was positive. However, this could change on appeal. In addition to this, also, Tim, its license renewal came with the condition that Lynas must ensure that a cracking and leaching plant is operational outside of Malaysia before July 2023. After this period, Lynas will no longer be able to import raw materials that contain naturally occurring radioactive materials. And this facility is being built in Kalgoorlie and remains on schedule and on budget for the financial year 23 completion date. So stay tuned for that. And with the reporting season now over, many investors would be wondering what opportunities have emerged from the reporting season, especially given the significant share price volatility in recent weeks. Now, investors can look for star stock opportunities by using the stock filter, which lies under the Tools tab. Here you can build your own filter or select from a list of predefined filters such as star growth stocks or star income stocks. For growth stocks within the field list, make sure you include EPSG, which is EPS growth, 1 year forecast, price change over 3 months, a technical indicator such as the SD30 TSR, also the EPS forecast 1 year 3 month revision, which we've recently added, and the number of analyst coverage to help you understand the reliability in those forecasts. And for income investors, you should also want to include gross dividend yield forecast, franking, forecast dividend payout ratio, and also days to ex-dividend date to understand when that dividend will be paid. But to look for opportunities, what you can do is sort the column by 3-month price change and look for companies with stable earnings revisions over a reporting season. Otherwise, you can look for those companies that are displaying a bearish signal on the SD30 TSR. And some of these growth opportunities we've found include Pinnacle Investments, ArbCorp, Tim, you mentioned earlier, James Hardie, Altium as well, Collins Foods came out, Pro Medicus, Aristocrat Leisure, Fish and Paykel, CSL, and also our long-standing REA group as well.
Yeah, the stock filter is a terrific tool, isn't it, to find a lot of stocks outside of the star stock universe to see some emerging opportunities, and financial health's a critical field to have in there as well. Or you could go to my filters, growth stocks and income stocks with potential to show some other non-star stocks that are on the rise. And obviously the watch list too, Kien, you can go into the star stock watch list and sort by many of the columns you've mentioned there too. And obviously a lot of the names you've mentioned there will pop up as opportunities. But for income investors, Kien, you can sort companies by the highest gross dividend yield and look for those with stable 3-month earnings revisions. So they've got the yield and they've obviously got that to give you the confidence that they've got the sustainability for future dividends based on the solid outlook for earnings. And some of these stocks that will pop up in both the watch list sorting criteria, all within the stock filter, are BHP, Rio Tinto, South 32, Super Retail Group, Macmillan Shakespeare, and some of the banks which are paying good gross dividends, well over 8% at the moment. So there's a plethora really of wonderful opportunities in this wild environment.
Yeah, that's right, Tim. The volatility certainly created opportunity. But again, thanks, Tim, for your time today.
Yeah, my pleasure, Kien. Again, our hearts go out to all of those who might be enduring, the consequences of some of the things that are happening around the world at the moment, but in Australia especially, the floods on the East Coast. And I think I don't need to re-emphasise anything we've spoken about today. Stock Doctor's a tool that provides you with everything you need. We're here to support our members in every way, and our investors in every way we can. But this is the market that I actually wait for and embrace. It's not once in a lifetime opportunity because they happen quite frequently these days. But that's the exciting piece, that there's always a reason to get excited about the market, especially if you're an opportunist. And if you're not an opportunist, well, Stock Doctor's got everything there to protect you from the current volatility as well. So yeah, it's all positive from our perspective, Kien. Great to be here.
Yeah, thanks, Tim. And just to remind investors, although inflationary pressures and rising interest rate concerns have led to this rotation from growth to value stocks, we believe this trade will unwind over the longer term. Therefore, take advantage of this opportunity to look for those oversold quality exposures, and you can do this through some of the very useful tools in Stock Doctor. Take care and have a happy, healthy, and prosperous week, everyone.